Opening and funding a health savings account is one of the most efficient vehicles for building massive wealth. HSAs are versatile accounts that were created to help you save money on qualified medical expenses. However, most savvy investors use their HSA as a long-term wealth building tool, and they pay their medical expenses out of pocket. In this video, we'll break down how you can properly maximize the effectiveness of your HSA for building wealth by covering the following topics. What is an HSA? What are the eligibility requirements? What are the contribution and income limits for 2023 and 2024? What are the tax advantages? What is a qualified medical expense? The penalties and tax treatment of non-medical or non-qualified medical expenses. But first, if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your net worth with simple, time-tested solutions. And real quick, if you enjoy videos like this, please hit that like button, subscribe if you haven't already, and tell a friend about the channel. It really helps spread the word, and I appreciate you. Let's get it. What is an HSA? A health savings account is a triple tax-advantaged account for people covered under a high deductible health plan. They were initially created to save money on qualified medical expenses. The contributions made to an HSA can be invested in things like stocks, ETFs, and mutual funds. And these investments will carry over year to year, and there is no carryover limit. This is one of the many aspects of an HSA that make it superior to a flexible spending account. HSA Eligibility Requirements. To qualify for an HSA, you must meet each of the following 4 requirements. You must have a high deductible health plan. You must have no other health coverage. You must not be enrolled in Medicare. And you must not be claimed as a dependent on someone else's tax return. You are able to open an HSA if you are self-employed. You do need to meet the aforementioned requirements. After that, you can open a health savings account offered by a brokerage or a bank, such as Fidelity, Health Equity, or Lively. I personally recommend Fidelity for their wide variety of investment options and 0 fees. Contribution and income limits. In 2023, the maximum limit for self-only coverage is $3,850. And the limit for a family plan is $7,750. And if you're 55 or older, you can also do a catch-up contribution of $1,000. In 2024, the maximum contribution for the self-only coverage was increased to $4,150, and the family plan maximum was increased to $8,300. And then 2024 used the same catch-up contribution if you're 55 or older of $1,000. And there are no income limits to contributing to an HSA. It doesn't matter how much money you earn, you can play ball. Tax advantages of an HSA. Now it's time for that part about building massive wealth. HSA contributions are triple tax advantaged if they're used for a qualified medical expense. The contributions are 100% deductible from the employee's income for the current year. So this is akin to contributions made to a traditional IRA. The investments grow in the account tax-free, and this is just like a Roth IRA. And eventually when you pull the money out to pay for a qualified medical expense, the distribution is 100% tax-free. And this is also like a Roth IRA. So this is one account that gets all the advantages of a traditional IRA, which is very powerful compared to a taxable brokerage account, and a Roth IRA, which is also very powerful compared to a taxable brokerage account. And if you were to compare which is better between the two, it depends on your income. There's pros and cons to both, but the HSA gets the best of all worlds. Let's jump over to my screen and take a quick look at the growth potential of the investments within your HSA compared to those same investments in a traditional IRA or 401k and a Roth IRA or 401k. I found an online calculator that can be used to assist someone in deciding whether to make traditional 401k or Roth 401k contributions. So that's pre-tax or after-tax. And you can find a variety of these calculators online, but this is a good tool to use for our case. So what I did here is I filled in some information. I put current age of 30 and age at retirement of 60. The numbers here don't really matter. What really matters is the 30-year duration. And then current income, I skipped because it let me directly put in the current tax rate. So we are assuming that this person is in the 24% marginal tax rate. So that's their tax bracket right now in their current earning year. And then retirement tax rate, when they take the money out down the road, if they choose traditional, we're going to say they're in a 12% tax bracket. That's what a lot of people are in now because you can control the flow of your income in retirement a lot easier than you can in your prime earning years. And for the hypothetical rate of return, I just use 10% to mirror about what the S&P 500 typically does over many years. And then the annual contribution, I use $3,000. So you can contribute more, especially if you're on a family plan. But I just wanted to put in a dollar amount that got us started just to show some of the differences between these. Just know that these numbers are a lot more scalable and they can get bigger if you max these things. So as we scroll down to the results, on the left here is the total money you have in your account before you take it out. On the right side is how much money you get net of taxes, so what it's actually worth to you purchasing power wise. So you can see the Roth 401k, you end with $395,000 in your account, and of course Roth grows tax-free and the distributions are tax-free, so you have the same $395k when you actually take it out. That's the value to you. The traditional, in this case, you have $519,000, and it's grown a lot more because you took full advantage of the pre-tax contributions in your higher earning years. So you got a much bigger amount compared to the Roth 401k. Those pre-tax contributions really do add up. But then you do have to pay the taxes at that 12% when you take it out. So your final balance here is $457,000. So in this case, if you're a fairly high earner, you should definitely go with the traditional IRA. Now, the point of this video, your HSA is worth $519,000. Remember, it gets those tax advantages of the traditional IRA. When you take it out, it's still worth $519,000, assuming it was used on qualified medical expenses because you get the tax advantages of the Roth. So just in this quick little snapshot example, a Roth is worth $395,000, ultimately for spending power. The traditional is worth $457,000, and the HSA is worth $520,000. As you can see, the HSA keeps a lot more money in your pockets and away from the tax man over time. Qualified medical expenses. The triple tax advantage only comes into play if you use the money to pay for a qualified medical expense. The following items are considered qualified medical expenses: deductibles, dental services, and vision care, prescription drugs and copays, psychiatric treatments, and the next one's a really big one, the insurance premiums on your Medicare plan, and long-term care insurance. Premiums for Medicare supplemental plans or Medigap policies are not qualified medical expenses. Now, a major life hack is that you can pay for your qualified medical expenses out of pocket and keep the receipt for that service. Then later, at any time, you can take a deduction against that previously paid medical expense as long as you had the HSA open during the time that the qualified medical expense was paid. Penalties and tax treatment of non-medical expenses. If distributions are made from an HSA account to pay for anything that is not a qualified medical expense, you will have to pay your income taxes at your current marginal tax rate and an additional 20% penalty for that money that you withdrew. In short, you should never do this, ever. And if you're blessed with good health your entire life and you never need to spend your HSA money, firstly, congratulations. That's a lot more important than anything money related. Secondly, when you turn 65, your HSA effectively becomes a traditional IRA. You no longer will pay the 20% penalty on the money you pull out for any reason. So you keep the advantages of those tax-free contributions you made years ago, just like a traditional IRA or a traditional 401k. You do pay taxes on the gains within the account at your current marginal tax rate at the time you take it out, which is usually a lot lower than your prime earning years. And remember, the money in this HSA account after 65 is still technically better than the money in a traditional IRA or a traditional 401k because the qualified medical expenses are forever triple tax advantaged. But eventually you can start to extract more money out when it becomes evident that you're a healthy person and you probably will never need this HSA. So in summary, if you're building this thing and the balance keeps going up and you're starting to get a little nervous that you'll never fully be able to utilize it, just know that at its worst, it is as effective as a traditional IRA, which is one of the better investments you can make, generally speaking, for most people, especially high earners. One minor disadvantage of an HSA account compared to a traditional IRA is that when you eventually pass away, if this account is not transferred to your spouse, the recipient of the funds will have to pay the fair value of whatever the account's worth in the current tax year at their marginal rate. There is no 10-year window to extract the funds in a tax-efficient manner, like there is with the traditional IRA. Now that you have your triple tax advantage money working for you, it's time to make some investment decisions. Check out this video right here if you want to set up a passively managed portfolio that has outperformed the market for each of the last 10 years. Thanks for watching, and I'll see you in the next one. Peace.